Okay, so we can go ahead and get started. Good evening and welcome everyone to tonight's program, Let's Talk Retirement. This program will last about an hour and there will be time for questions at the end. You can go ahead and enter any questions you have in the chat. A link to the recording of this program will be sent out once it's uploaded to our YouTube channel. Without further ado, please join me in welcoming Scott from Bloom Advisors. Welcome, Scott.
Thanks a lot, Sarah. Appreciate you having me out tonight, and thanks everybody for logging in. So looks like we've got a pretty good crowd tonight. So again, my name is Scott Whyte. I'm one of the financial advisors with Bloom Asset Management, and also sit on the investment committee, or I'm an investment committee member, which means I help with the picking of the investments that we recommend to clients and the strategies that we use, those types of things. And so I always like to give just a little bit of a commercial for us before we get into it. So, Bloom Advisors, we manage primarily personal investor money, about 1,200 households, and we've been in business for just about 40 years. And we have right now about 1.3 billion of client assets under management, and 20 employees, about 6 advisors, and the rest support staff. One of the interesting things, kind of neat this year, is we were recently named by CNBC as one of the top 100 financial advisors in the U.S. out of more than 40,000, and we're the only firm ranked in Michigan. So we certainly appreciate that honor. And like to always mention our website, bloomadvisors.com. There's helpful resources that you can check out. And, there's things like a financial glossary, there's a budgeting template. We also have a variety of milestone checklists that are things like, hey, I've reached Medicare age, what do I do? There's been a death of a spouse, what do I do? Newborn, planning on, looking at college education, what are some things? And so variety of those checklists for different life events can be very helpful. And tonight, what we're going to be covering, essentially what I think of as the foundation or the most important topics when it comes to retirement and retirement planning. So that would be expenses and retirement income sources. Definitely very important, building a retirement portfolio that works for you, because really nobody's getting by on just Social Security anymore. And frankly, a lot of folks that are entitled to a pension are already retired. So I also like to spend some time talking about how you can maximize your retirement income by minimizing taxes. And there's no gimmick to that or, product of the week that involves. It's really just about looking at, the types of investments that you've built up over time, whether it's, traditional, taxable investments, as we call it, things that are in your name, or money that might have been in a 401k or an IRA or a Roth, and determining which is the best order to distribute those from. And then, of course, we'll have some time at the end for questions, good old Q&A. But again, as Sarah mentioned, if you have some questions that come up as we're going through these slides, definitely go to the chat and type them out, and then I'll make sure to get to those. And depending on, sometimes I bounce back and forth. If I see a question hop up, if I can address it during that particular slide, I'll do that as well instead of waiting until the end. So without much further ado, we'll talk about expenses and income sources. So when it comes to the first building block, probably the most important one is understanding what it's going to cost you in retirement to live. So understanding your expenses first and foremost. And it probably goes without saying, but I like to say it anyway. A budget in retirement is not the same as the budget while you're working. So most of us, while we're working, might be dealing with kids and college education, or just, the idea that even if you don't have those things going on, that some of your money every paycheck is going towards retirement savings, hopefully. And so what you'll find is that some of these rule of thumbs that people throw out there, I always say that the financial talking heads, the experts, they'll say, well, you need 80% of your income while working. That's what you're going to need in retirement. I really do think that's the wrong approach. It's far better to sit down with, either pencil and paper or a spreadsheet, or, whatever kind of system works for you, and really outline what your budget looks like. And if you've never done a budget before while you're working, planning towards retirement, you absolutely need to be doing a budget. So otherwise, you're going to, probably undershoot as far as, guesstimating what kind of income you need. But again, I don't think 80% of income while working, or even 100% of working, is the right approach. Oftentimes, less than that is required, but it really depends on, kind of what your goals are for retirement. So, as a perfect example, lifestyle changes can have a big impact on your retirement expenses. In other words, are you going to, move out of Michigan, or, to a warmer climate per se? Or are you going to do something like, get a second home in Florida? Because again, you want access to warmer climate versus the Michigan winters. And most importantly, when it comes to the budget, you got to remember that inflation is an important consideration. So these days, I think most people, inflation is top of mind because we've gone through a period of last year and a half or so where, the Fed has been raising rates to try and tamp down inflation. And we've definitely experienced a spike where inflation was running 9% last year. It's running about 4 right now. And historically, inflation only runs about 2%. But you definitely need to plan for that when you're thinking about your expenses. In other words, your expenses are going to increase in retirement. And so you can't really think of, if when you retire, let's just throw a figure out there. Say if you think you need $50,000 to comfortably live, well, that might be fine in year one, but in year 10 or year 20, as most retirements tend to span, at least a decade or two, you'll find that inflation has an impact. And even if 50,000 a year was comfortable in year one, probably by year 10, you might need 55,000 a year. And if you're not taking that into account, again, you can run into some trouble further on into retirement. So I'm just checking this question real quick. Yeah, so that's a good. This is a good one. So there's not that they're not all good questions, but this question that just came up is: if retiring at age 55, how much should be budgeted for health insurance before Medicare kicks in? And I will tell you that it varies, based upon, kind of the situation, whether you're a single or a couple. But I will tell you the number pre 65, in other words, pre Medicare, it can be kind of staggering. So if you're not getting subsidies, it would not be out of the ordinary to, as an individual, be looking at $1,000 a month in health insurance and other expenses related to it. In other words, being able to meet a deductible, because most plans people go with these days are high deductible health plans that allows the insurance premiums themselves to be lower. But then when you have expenses, you need to kick in to pay them until you reached a certain level. And for a couple, I'll be honest, you almost want to earmark, in the high teens, 18,000 a year, probably is a pretty good number, which can be staggering. And it just goes to show you that there's, a huge benefit to waiting until Medicare age at 65 to retire. If you're planning on retiring early at age 55, healthcare most likely is going to be your largest expense, especially if you've already taken care of other expenses like, paying off your mortgage and things like that. So, um, so income sources. So this is definitely, kind of like the yin to the yang. So expenses are that foundation. What is it going to cost you to live? And then the income sources are, how are you going to cover it? And basically make sure that you're comfortable. So again, many workers no longer are eligible, or pensions may be frozen. What I find when I'm working with folks these days in our business, there's probably less than 25% of, newly retiring people are eligible for a pension, about a quarter. If you would have asked me that 10 years ago, I would have said, yeah, you know what, about half of the people have pensions. So pensions used to be a very important building block as part of your income source during retirement, but they tend to be, less available these days. So if you are eligible for a pension, it's important to understand your options. So in other words, typically when you're talking a pension, you're talking a monthly check, monthly income that you're going to receive for the rest of your life. But sometimes you can consider a lump sum instead of a monthly pension. So what you'll find, just as an example, things change. So there were times when lump sums could be pretty preferential as compared to taking a monthly pension. But because interest rates are high right now, the way the calculations for a lump sum work, you'll find that today, compared to just like a year ago, you might receive as much as a third less in a lump sum compared to taking a lump sum a year ago versus the same monthly pension. So in other words, monthly pension, I'm just making this up, $3,000 a month a year ago. Same monthly pension now, $3,000 a month. The lump sum amount might have been 500,000, a year ago. And if you were to consider lump sum versus that monthly pension now, you might only be looking at 350 as the offer. So it's important to consider a lump sum if they're out there, but I do find with interest rates high, it's less likely that a lump sum is going to be preferable to versus taking the monthly pension. And also an important consideration, does your pension have a cost of living adjustment or COLA? Most of them don't, but I find that some do. Typically, it's teachers' pensions, as an example. They tend to have they tend to have a COLA built into them. But most other pensions, I find no COLAs. So it's just going to be a fixed amount. And what you'll find again is year one, the pension might seem like a good number, but by year 10, it's going to seem like it's less. And certainly by year 20, that pension is going to seem like it's really not all that great compared to what it was originally. And then the other thing is, what are the survivor options? So if you're married, it's really important to look at, whether you've got a survivor option. And typically you'll find things like an option where you'll get a certain amount if it's just single life. So in other words, you, the pensioner, die, your survivor gets nothing. That will tend to give you the highest monthly payout. On the flip side, if you get 100% survivor, so in other words, you die, pension's the same upon your death to your survivor, that tends to give you the lowest payout. But again, for a married couple, that tends to be a pretty popular way to go. And then what I tend to see otherwise is, there might be a 75% survivor option or a 65% survivor option. And again, depending on your particular situation and whether the other spouse has a pension or, what their social security benefits are, you might be able to look at some of those other options. But I find usually it's fairly black and white, is that if you're single, you're going to take that single life option, and that's going to give you the highest payout. And if you're a married couple, you're going to tend to lean more towards that 100% survivor. So that's one piece of it. And then Social Security is another very important piece. I find for a lot of couples that I work with that Social Security might make up half of the income that they need, in retirement to be comfortable. And so there's options with Social Security. And I would hate to say like you can screw it up, but you can. In other words, there's not one right answer for collecting Social Security for everybody, but there's definitely a lean in my book towards collecting later. And that's because of the way the benefit system works. So if you collect Social Security as early as you possibly can, which is age 62, you're looking at a 25 to 30% permanent reduction in benefits. And that 25 to 30% is based upon when you were born. So the older you are, more likely you're going to see a 25% reduction. The younger you are, the more likely you're going to see a 30% reduction. And collecting benefits at full retirement age is basically my general recommendation for most people, which is again 66 in 2 months. Would be the earliest full retirement age on up to age 67. And so someone like myself, so I'm only 55, because I was born after 1960. My full retirement age is 67. If you were born between 55 and 60, then it's a range of 66 and 2 months on up to 66 and 10 months to get your full retirement age benefit. And the other thing is that if you delay your benefits all the way up until age 70, you can get as much as a 32% permanent increase in those benefits. And that's a permanent increase from the full retirement age. So if you're looking at from age 62 to age 70, it's literally almost a 50% increase. It's gigantic. And so, again, my general recommendation, I like to see people wait until their full retirement age to collect, even if they are retiring before their full retirement age. I'd rather have them draw from their portfolio than to draw the Social Security benefits. And the reason for it is that you're getting about a 6 to 7% increase in the benefit you receive for every year you delay. So that's all the way from age 62 to age 70. The other thing to keep in mind is spousal benefits. So if you've got, say, a married couple, and basically both of the couple, if they worked, they're both going to have their own benefits. But if you have a spouse that was making quite a bit less than the other, they might be eligible to take spousal benefits. And what that amounts to is 50% of the higher earnings spouse's benefit at their full retirement age. And so the way that works, just kind of in simple terms, is if you've got a higher earning spouse eligible for a $3,000 benefit at their full retirement age, and the lower earning spouse is getting 1,000 at their full retirement age. Well, if they both wait until full retirement age to collect, the higher earning spouse is going to get the 3,000 a month. The lower earning spouse, instead of getting their $1,000 benefit, they would actually get $1,500 a month. So 50% of the higher earning spouse. The other thing to keep in mind too with Social Security is there's a survivor benefit, which just means that if you got a married couple and you're both are collecting Social Security, you're both over full retirement age, one of you passes away. What happens there is the lower earning spouse's benefit falls away, and they assume that higher earning spouse's benefit. So again, back to my example, $3,000 a month for the higher earning spouse. The lower earning spouse was going to get 1,000, but they got 1,500 because of the spousal benefit 50%. So then the higher earning spouse passes away. Well, what happens there is the lower earning spouse's $1,500 goes away, but instead they start collecting the $3,000 a month. So the higher of the two benefits is what always occurs there. And moving on there, so part-time income. This is, here and there, I think this has become a more popular option. So especially I think with people like the one who mentioned about retiring at age 55. When you retire at age 55, sometimes you're really going to consider part-time income so that you can get health benefits. Working at least 20 hours a week, you qualify for health care benefits. And, that's where it really comes into play. So if you don't have adequate resources when you retire, you might need to continue working to supplement your income, cover healthcare costs prior to reaching Medicare age. And you'd be surprised, even a small additional stream of income can make a difference between a retirement plan working or failing. And, I was going to, I'll save that question about lump sum versus monthly pension. We'll save that for the end. We'll get back to that one. So, because I don't think it really fits right here. So between pension, social, part-time income, then the fourth sort of leg of income resources is withdrawals from your portfolio. And this is the one that, I'm sure, spend the most amount of time in my day talking with our clients about, which is, how much can I take? What do I need my portfolio to get to take the kind of monies I need? So you need to think about what's comfortable and sustainable. And the word that we use is withdrawal rate. And, I know a lot of people outside the financial industry probably have no clue what that means, but it's essentially looking at and saying per year on a percentage basis, how much can you draw from the portfolio? And what I will tell you as a professional who's been doing this 30 plus years, what I've found works in most cases is a withdrawal rate that's no more than 3.5% to 4% of the portfolio per year. And so in other words, if you've got $1 million portfolio, that means you can withdraw on a gross basis. So before you're accounting for taxes, you can withdraw about 35,000 to 40,000 a year. Again, it's a benchmark number. It doesn't work for everyone. You definitely need to look at your unique situation. But I'll tell you, one of the things that cropped up earlier this week, might have been even last week actually, that I thought was just ridiculous. And I won't name the person because that's not what we do. But a very prominent guy on Twitter and person that has been working with folks for a lot of years was talking about an 8% withdrawal rate being reasonable. And of course, they were also talking about 12% returns being just the bare minimum that people earn. And that's one of the important things of working with a professional like Bloom is we can help you kind of demystify and throw out a lot of those garbage numbers. 8% withdrawal rates, you'll end up being broke within 15 years unless somehow the sun, the moon, and the stars just align in some perfect way that we've never seen. Similarly, 12% returns on an annual basis are just ridiculous. Stocks historically have averaged about 10% of return per year. But because you're not going to invest 100% of your money in stocks, you're going to tend to, moderate your risk by including bonds. Bonds typically earn about 3% a year. You can really look at, realistically in retirement, maybe earning 6%. That's a much more realistic number. And that's why if you look at this 3.5 to 4% withdrawal rate, it tends to work out pretty well in that it gives you some wiggle room over time. There's a margin of, not error, but there's basically a margin of excess return relative to the portfolio. Now, you want the diversified portfolio, you're not going to earn 6% year in and year out. There's going to be years like 2022, where even a well-diversified portfolio drops 15%, 20%. But you're going to see other years like 2020, which was the year of the pandemic, where things swooned in the early part of the year, but by the tail end, a diversified portfolio was up 20%. And so you're going to have those years in there, but over time, a diversified portfolio that's reasonable and isn't 100% stocks, you're probably looking at about a 6% return. So, I actually put in my slide here, if you expect your portfolio to earn 5%, you may need to draw less in order to provide for returns that vary year to year. In other words, you could earn 10% one year, lose 5% another year. But again, I think 5%, very reasonable return to expect from a diversified portfolio in retirement. 6%, I think can work as well as far as expectations. And retirement confidence. So there's over the last, probably decade or so, there's been a variety of tools that have been developed to help with what we kind of refer to in the industry as retirement confidence. So it's really analysis and using technology to help you build confidence in your retirement plan. Largely what that comes down to is Monte Carlo simulations, which what those are is taking your various inputs. In other words, what's inflation expectation, what are market returns expected to be, varied withdrawal rates over a period of time, and market returns that don't move in a straight line. So in other words, sequence of returns really matter. So if in year one of your retirement, markets go down 20%, as we know, that's bad. So what Monte Carlo simulations do is they throw typically 1,000 or more different market scenarios at your data. So what do you have for Social Security? What do you have for pension? How big is the portfolio and what can you draw from that? And then over 1,000 different simulations the next 20 or 30 years, how often do you run out of money in retirement or not? And typically when you're looking at that, we're usually looking for a confidence factor that's in the 80% level. And it's important to conduct analysis that acknowledges that market returns are not fixed and they can vary dramatically from year to year. So again, back to this slide here, you don't want to take the fact that Scott Whyte said, it's reasonable to expect your portfolio to earn 5% and then plug it into a spreadsheet and say, well, for the next 20 years, I'm going to earn 5% a year. Doesn't work like that. there's going to be up years, there's going to be down years. And so that's why, when you look at it, it's good to use retirement analysis that takes into account a variety of different returns. When I first got into the business 30 years ago, that's the only way that retirement analysis was done. People assumed fixed returns, but it was very flawed because what you could do is say, okay, I'm going to assume my fixed return is 6%. So I'm going to withdraw 5.9% and I'll be good because I'm not taking out exactly what I'm earning. I'm actually leaving a little bit to account for inflation. But again, markets don't work like that. They go up, they go down. And so there needs to be a margin of excess return between what you're drawing and what the portfolio is actually returning in order to not run out of money over the long term and to provide for the impact of inflation over time. If your portfolio isn't growing in retirement, then what's happening is your purchasing power during retirement is shrinking. And nobody wants to be in that situation. So how do we, get there? Once you are looking at, investing some of the money besides just, relying on pension and social, you got to build a portfolio that works for you. And so, from our standpoint, and again, we've been doing this a long time, we're big believers in investing in a globally diversified portfolio. It's really critical to provide diversification, which includes a variety of different asset classes. This gives you the best chance of keeping up with inflation and providing a rising income stream in retirement. So U.S. stocks need to be an important component and generally are one of the largest pieces of the asset allocation, coupled with foreign stocks and emerging market stocks. So, when we talk about foreign stocks, we're talking about developed economies and countries. Things like in the Europe region, as an example, the UK and Germany and France, and over here Canada, and as an example, they're considered a foreign, developed country. And then emerging markets, we're typically talking the smaller economies that are less developed, things like India, Pakistan, China, Taiwan, Thailand. There's a host of different emerging markets, and emerging markets are more aggressive, than international markets like the foreign developed, which tend to be a little bit more aggressive than the U.S. But what you need to do is have a mix of those when it comes to stocks in order to provide the smoothest ride. So what we've seen over time is that you tend to have periods of years, 3, 4, 5, sometimes longer, where U.S. stocks perform the best. But then that tends to trade places with foreign and emerging markets where they might run for 3, 4, 5 years where they're actually producing the best returns. And we've been in a period the last couple of years where US stocks have absolutely outpaced foreign stocks. So there's a greater likelihood because market returns eventually return to their mean. So what they've done over the long run. So there's actually a greater likelihood right now that international stocks could perform pretty well over the next several years. The other thing, again, relative to US stocks, the other component of the portfolio that's very important to have and balances the stock piece are bonds. And we look at traditional and non-traditional bonds. Traditional would be things like mortgages and treasuries and AAA rated corporate bonds. Non-traditional bonds tend to be, high yield notes, international bonds, floating rate bonds, as an example. Right now, because we've been in this rising rate environment, non-traditional bonds have really helped, soften returns. As rates were rising, traditional bonds were getting clobbered. But over the long run, we believe having a mix of both of those is important within a portfolio. And the easiest way to build these portfolios is by using mutual funds or exchange traded funds. So looking for low cost, easy to understand investments that provide diversification. Sure, it's sexy to go out and buy Tesla or Amazon or something like that. But if you're using a mutual fund, you're going to own Tesla and you're going to own Amazon if they're good companies, right? But you're going to also own 150 other companies in there, and you're going to get diversification. So if one company in the portfolio blows up, it's not the end of your retirement. And I've found over the years that although I have owned some individual stocks here and there, the smoothest ride tends to be with diversified investments like mutual funds and exchange traded funds. So, and you can get those through, any number of brokerage firms, Schwab, Fidelity, Vanguard. They all have marketplaces where you can get literally thousands of different mutual funds, and you can use resources like Morningstar to determine, what have been good performers. Whether they'll be good performers, that's another story. Or you can look at hiring an advisor like Bloom. That's pretty much part of the business that we do. We do retirement planning, but because we're building portfolios, we're constantly looking for, what are the best funds to include in a diversified portfolio. And again, diversification, it's critical. So investment performance year to year is pretty unpredictable. I call this chart the eye chart. But basically what it'll show you is that various asset classes bounce around. One year you might find, like back in 2008, fixed income bonds, they were actually the best investment, earning about 5%. Cash, which earned 2, was, also like a good investment. The very next year, 2009, cash and fixed income at the bottom of the pack. And you'll find the same thing, happened in, 2018. 2018 was basically cash and fixed income at the top. And then when you roll into 2019, cash was at the bottom, fixed income was very close to the bottom. So when you're building a globally diversified portfolio, where your portfolio returns tend to lie is in this white area with the lines through it, the asset allocated portfolio. So it's never at the very top of the returns, but it's also never at the very bottom. It tends to really cut the middle ground. And that is really the way that I like to see, in that, again, you don't need to hit home runs. You want to avoid strikeouts. Someone who's, to use the baseball analogy, if you're hitting singles and doubles all the time, that's absolutely fine. And that's what a globally diversified portfolio can provide for you. So, diversification can feel disappointing in the short term, but it has longer term benefits. And this chart just kind of shows you a couple of different, cherry pick time frames. 2000 to 2002, which was the tech implosion. So tech had been doing really well in the late 90s, and then once we got into 2000, everything lost money. All the four horsemen: Microsoft, Intel, Cisco, Oracle, they just lost, half of their money. And so, here's a period where if you just invested in the S&P, you lost 40%, which was huge. A diversified portfolio, you lost money, but definitely a lot less. Then you had the period of right after that big bust, 2003 to 2007. S&P was up huge, 82, almost 83%. Diversified portfolio, almost the same. Didn't make as much money, but you still had a really nice return over a 5-year period. Then you had the financial crisis in 2008. Stocks dropped 37%, diversified portfolio is down 24.5%. Here again, lost money. And then when you look at 2009 to 2019, which was just a really strong time period cumulatively for stocks, the S&P 500 was up 350%. Diversified portfolio only 195%. Still a great return over 10 years, but you didn't make as much money. And then you rolled into the first quarter of the pandemic year, 2020, lost 30% in the S&P, 20% in the diversified portfolio. You made a ton back, 70%, between Q2 and Q4, but a diversified portfolio made 42%. And what's interesting is when you average this all out over that roughly 20-year time frame, you're looking at that initial $100,000 investment that's invested 100% in stocks, only growing to 368,000. Diversified portfolio goes to 375. Excuse me. And the reason for that is just that when you can limit your downside, and again, 2000 is a prime example of that. When you can lose half of what the stock market loses, that has a significant impact on sustaining wealth long term. And that's why diversified portfolios are important. So it doesn't make a lot of sense, even though the highest returns are from the S&P 500 long term. Just doesn't make sense to expose your portfolio to that much risk consistently, nor in retirement. So how should you prioritize saving for retirement? It's pretty straightforward. If you're, working for a company that offers an employer retirement plan, you absolutely want to take advantage of that. And primarily because most companies have a company match. So what you want to be doing is looking at that 401k at a public company, or 403b through what could be like a charitable organization, or teachers, as an example, tend to have 403bs. Hospital workers tend to have 403bs. But the basic gist of it is you can invest on a pre-tax basis, and you can take advantage of company matches. And so if your employer is offering a company match, you absolutely want to save at least enough to get 100% of that. Like my daughter, she just started, like she graduated earlier this year, just started working at the Michigan Economic Development Corp out in Lansing. And so she's offered a 401k. And what she was telling me is basically, yeah, Dad, they match dollar for dollar up to 5%. And I said, well, there's an easy goal. You want to save at least 5% to get 100% of that company match. Otherwise, you're just throwing free money out the door. And if you're eligible, which is based upon income, there's actually a level of income that can be too high. But if you are maxing out your company retirement plan, you could consider contributing to a Roth IRA. Roth IRAs are a little different in that earnings are growing tax-free over the life of the plan, but you don't get any tax break upfront when it comes to a Roth IRA. Flip side, the 401k, why I'm really a big fan of that is that you're getting a tax break. For every dollar you put into a 401k, that's a dollar that's not taxed by Uncle Sam. And it's one of the few ways that you can just very simply avoid taxation on your income. And then if you're, doing both of those and you still have additional monies to invest in, then the third spot is to really look at non-retirement accounts using tax efficient investments. So you might be investing money in your individual name or joint name, or maybe even in the name of a trust. And what I say when I refer to tax efficient investments are things that have low distributions and payouts. So either low capital gains distributions like an index fund, or municipal bonds, which have tax-free income as an option. But you got to remember, when you're investing in that non-retirement account, even though you might be investing with retirement as the goal, everything you do, getting a dividend, getting a capital gains distribution, making a sale, everything there is exposed to taxes. On the flip side, money that's invested in a 401k or a Roth IRA, you can go wild, day trading, do whatever you want, have something that's paying a 10% distribution every year, and it doesn't matter to your taxes at all. What matters is when you start to draw that money out, which we'll talk about in a little bit. So, what about annuities? So, we don't recommend annuities, generally speaking, at Bloom Advisors. And the reason I bring it up is that unfortunately, a lot of advisors and a lot of insurance people do recommend annuities for retirement savings, or as a way to invest your money into retirement. And what you're basically told is your principal will be protected, and you'll get stock market returns. And it sounds too good to be true. And the reality is, it's not true. So I'm a big fan of saying annuities are sold, they're not bought. No one really goes out and says, I want to put my money into annuity. What typically happens is an advisor who's going to get a fairly hefty commission targets investors and says, hey, I'm going to try and pitch them on some of the benefits, such as tax deferral or principal protection. But there's a lot of caveats. So when you're looking at an annuity, participation rates really matter, and they don't include dividends. So in other words, if you're looking at an annuity that is pegged to the S&P 500, well, right out of the gate, you're not getting dividends. And then typically your participation rate is going to be capped, might be capped at 5% or 8% a year. So when you have a great year like 2020, markets are up 40%, you're getting 5 or you're getting 8. So there's those caps on returns. And the other thing, the downside with annuities is they tend to be long commitments, often 7 or 10 years that you need to put the money in. And if you draw the money out before then, you're subject to surrender charges that could be as high as 10%. And generally speaking, for some annuities like variable annuities, they have very high fees. So you're talking, there's an insurance wrapper fee just to have the money in an annuity. And then there's the underlying investment fee, which typically you'll find annuities have fees, upwards of 2.5 to maybe even 3%. So how do you maximize your retirement income by minimizing taxes? So that's really looking at, an order of withdrawal in a sense, so planning ahead. Taxes depend heavily on which accounts you draw from and in what order. And my general rule of thumb, although again, this isn't perfect for everybody, and the next slide we'll kind of talk about it, is generally you should be prioritizing following this order prior to age 73. And why is age 73 important? Because that's the age when you're required to start taking minimum distributions from your IRA. So at that point, you kind of change up your strategy. But prior to age 73, it's typically most advantageous to draw from your non-retirement accounts, something an individual, joint name, trust name, because when you sell those investments and use that money for income, you're only paying tax on the gains that you've made, and you're also able to take advantage of the long-term capital gains rate, which is at max 15%. But if your income's low enough, the capital gains rate is actually zero. So after that, if you've run out of non-retirement accounts or didn't have non-retirement accounts, you're then going to look at your IRA or annuity as the next bucket. Um, Distributions from IRAs and distributions from the earnings on annuities are taxed at your ordinary income rate. So a lot of folks in retirement are either 12% or 22%. So you can see if you're in that 22% bracket, your ordinary income rate is going to be higher than the long-term capital gains rate. If you happen to be in the 12% income rate, that's where your long-term capital gains rate is zero. And then lastly, the last resort drawing from in retirement should be your Roth IRAs, because the money in Roth IRAs is growing completely tax-free. What I like to do there is essentially let that money defer as long as possible to maximize the tax-free benefit. So, and then after age 53, we kind of flip that, and you should prioritize in the following order. Essentially, IRA accounts are where you draw from until you've satisfied your minimum required distribution amount. And then you could draw from your non-retirement account. And again, lastly, the Roth IRA. And minimum required distributions, I talk about this, and this is where you might do to have a different strategy. So you've got the minimum required distribution or MRD time bound. So if you've been an aggressive saver using 401ks, the pre-tax employer retirement accounts, you may have saved enough that once you reach age 73, your minimum required distribution requires you to take more than you need for income purposes. So effectively what's happening is maybe you need 20,000 from your portfolio and your minimum required distribution is 40,000. So if that's the case, then you're basically getting taxed on every year after age 73, 20,000 worth of income that you don't really need for income purposes. So if that happens, or if that's likely to happen, and you kind of do this with a little bit of modeling, you could consider changing the priority for income withdrawals. And then prior to age 73, you'd actually place the IRA withdrawals at the top of the list. So even though you'd be paying a little bit higher tax prior to age 73, you'd be spreading those distributions out over a bigger number of years. And then by the time you reach age 73, the minimum required distribution would be smaller and less of an impact. Now, if you don't need income from your portfolio prior to age 73, the other thing you can consider is converting a portion of your traditional IRA to a Roth IRA on an annual basis. And that's again a way just to reduce the IRA balance. And therefore, when you hit age 73, the minimum required distribution is less. And so we're going to open it up into Q&A here momentarily. I know there's one or two questions to answer, which I'll get to. But again, I would just, suggest to you that, check out our website, boomadvisors.com. Variety of information, resources, and blogs that we update regularly there, and leading into the questions. So first off, I had one about, aside from interest rate, what other factors should you consider with regard to lump sum versus the monthly pension? And really, what I tend to do there is I look at it and I really see, I do it like what I call a time value of money calculation to really determine is if the lump sum were invested at a reasonable rate, what would that equal to? And then how does that compare to the monthly pension over a typical life expectancy, usually like 84 as an example, or even longer? And you can do math on that. It's fairly simple with a financial calculator. There's a lot of online free calculators where you can do a time value money calculation, but you're basically looking at an annuity versus lump sum. Annuity meaning monthly payments versus the lump sum. And then the other question that had come in was single premium immediate annuities to guarantee an income along with Social Security and pension so that your basic needs are met. So I would tell you that that's about the only type of annuity, single premium immediate annuity, that I would ever recommend to a person. And basically, what the single premium immediate annuity does, it allows you to take a lump sum of money. It doesn't have to be all your portfolio. Maybe it's 10% or 20%, but you're basically entering into a contract with the insurance company and you're exchanging, effectively giving up that lump sum of money in exchange for a monthly income benefit for the rest of your life, or maybe a joint life, you and a spouse. And that's really a way for folks that have some money in their portfolio, but they don't want to take as much risk of the portfolio providing their income for the rest of their life. So they're willing to give up some of it and trade that off for a fixed income. And basically, where the single premium immediate annuity can make some sense is for a person who doesn't have a pension, or between their pension and Social Security, they don't feel it's going to meet all of their needs. So I mean, that's definitely a valid option, but it's important to look at that relative to, kind of like your entire picture. And we absolutely, for clients of ours, we look at scenarios where you kind of compare. What if you take some of the money as a lump sum, put it into a single premium annuity, or do you end up being better off just letting the money ride in the market? So, but definitely a valid consideration. Um, question here came up, wouldn't I want to draw from taxable accounts in IRA once I retire, but before I start Social Security to fill up all the lower tax brackets? And now this person's assuming they're going to wait all the way until age 70 to draw Social Security. And no, this is definitely a valid approach. So in other words, if you don't have other income sources in those early years or those pre-age 73 years, you could take a look at drawing from your IRA. But that being said, if you're not facing an IRA time bomb, I would still tend to defer to drawing from non-retirement accounts before IRAs. That's my professional opinion on it. So, so the question are, those withdrawals will likely cause my Social Security to be taxed in later years, yes or no? I would tell you for most people, your Social Security is going to be taxed. So as a married couple, if you've got income, in retirement that's basically above 44,000, so that's income, ordinary income, pension, other sources, investment income, and then half of your Social Security. If that adds up to more than 44 grand as a married couple, then your Social Security is going to be taxed. At most, 85% of it will be taxed. And if you were below a lower threshold, then maybe only 50%. But you'd basically have to have like below, I believe the number is 24 or 25,000. I'm going from memory on this one, of what they call combined income to not have your Social Security be taxed. So at the end of the day, IRA withdrawals tend to not be the big impact of whether your Social Security is going to be taxed. It's everything else. And I would say, generally speaking, most people, you're going to be looking at taxation on your Social Security. So with that, I think we're approaching 8 o'clock, and I would tell you, if you've got other questions that come up, feel free. You can email me. Definitely appreciate your attendance tonight. And again, my email address, scott@bloomadvisors.com, if you happen to come up with some additional questions.
Thank you so much, Scott, again. And once again, the recording of this presentation will come out probably tomorrow when it's on our YouTube page. Thank you again, everyone.
All right. Thanks again. I appreciate everybody showing up tonight, and you have a great evening. I'll stop that share there, and we will exit on out.